Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for the week ending on June 24th. My name is Ian Saunders, and joining us today is Steve Raymond. So we are recording this podcast a little bit early this week. We're recording it Wednesday afternoon here, Steve, instead of on the typical time on Thursday. But in coming in movement, I mean, we've seen some pretty interesting market movement. I mean, over the course of the past few months, led to some interesting changes, which we can get into here in just a sec. I mean, the past couple days, though, I've seen a little bit of a swing to the upside for some of those laggard areas, right? We've seen the S&P bounce a little bit, the Nasdaq bouncing a little bit more. It's up another percent, at least at the time of this recording today. But that's really after some pretty sharp deterioration from a lot of these kind of big major market core indices over the course of the past several months, and then more kind of more last week as well, which led to some notable indicator shifts across some of the big broad market or broad asset class indicators that we have on the platform. I mean, I know we're going to dive into a few of the different cash indicators or cash potential raises that we've seen move on across the platform. And the one that's going to come to at least the forefront of a lot of individuals' minds that follow that broader DALI, that dynamic asset level investing tool, is the overtaking of domestic equities by cash. So for those that are maybe a little bit unfamiliar with that tool, it's ranking 6 broad asset classes by relative strength. And we've seen commodities hold on to that top spot, but domestic equities had been in that second position for a lot of this market turbulence. And we saw some of the moves last week, I guess, Steve, see cash rise above that domestic equities ranking. So now we have still commodities in first, cash in second, domestic equities in third. I mean, Steve, how does some of that, what is some of that, why did it wait this long to happen? I guess, is a question a lot of people might be looking at.
Yeah, I mean, there could be several answers for that. The similar to the 70s, similar to the late 90s into 2000, that there was at least one could say, and I think certainly in this 2022 paradigm, where institutions, big money is holding on to that S&P core as their defensive piece, rather than trying to move to fixed income at the first sign of trouble as we crossed over the year. So, yeah, it takes a while, and we're not sure that they've totally divorced the core of equity, but we are sure that equity is stepping down, starting to leg down in certain indications, bullish percent, trend, moving average, and then relative leadership, as we're discussing today. It's been notching down in a thematic or orderly way. Mm-hmm. Sometimes it's very sharp. In fact, the old rule of thumb, you want to see sharp corrections. And that typically is a sign of a bull market correction, sharp, quick. And
maybe not as sharp as we got in 2020. But...
Well, and that qualifies as a bull market correction, right? So but now we've got this methodical stepping down in different core readings. We have different instruments that read it different ways, but all of them have been bleeding, if you will, mm-hmm. in a slower format than other corrections or other situations we may have seen in the past. So it can make sense. Not every correction or bear market has the same footprint. They're like snowflakes, but you can group them into two areas: a long, drawn out bleed down, or a quick, violent, more corrective type, which is generally leads back to a bull market very quickly.
Right. And so they're kind of more drawn out environment. I mean, it's certainly kind of what we find ourselves in now.
It seems so. Right. You've got 6 months of really methodically. In fact, I think we could look at different indications that one could point out each week the indication gets worse than the week before, which led up to last Friday, which was true also, meaning that last Friday your readings on domestic, but let's just say all equity, including non-US, and various sectors, whether they were laggards or just general equity, let's say, they've all had lower readings. Mm-hmm. In fact, Friday would be a low reading in equity in general. I don't care if you use scores or DALI or mm-hmm. different things. Mm-hmm. That would be true. But it's quite amazing, to see that cash move above the equity.
Yeah. And I think you brought up a good point there that's worth diving into some of the different kind of cash readings that we have, right? I mean, for those that might not be as familiar with the Dolly ranking, Dolly is looking at 6 broad asset classes, right? Those 6, right. You have commodities, cash, domestic equities, international equities, fixed income, and currencies. So those 6 kind of core asset classes. And then it's looking at multiple representatives from each asset class, but equal representation, to see, okay, how many times is the commodities representatives has the same amount of names as the other asset classes? How many times the commodity names beating everything else, right?
Right.
We then kind of tally up those wins and get at the Dolly ranking that you see displayed on the system. So just because we saw cash move above domestic equities doesn't just mean, hey, this one representative passed domestic equities. And I think, as you were saying as well, Steve, it's not just that we saw. I mean, it's not just that we saw that broad weakness from domestic equities to international too. And a lot of that can be seen perhaps more so through some of the other indications like we have. I mean, if you want to kind of draw the line between some of what we're seeing on the Dolly page, which is that strictly relative strength-based analysis, tends to be a little bit more, it takes more work to see some changes there. There's bigger broad market picture changes. Or something on the group scores page, like you mentioned. I mean, you might have seen some of these changes occurring, at least from a cash perspective, a little bit earlier on.
Yeah, and we have different. We have actually more than 2. We have several systems to work with cash. The whole idea is to measure what the risk-free rate's doing, to figure out, well, should we have some risk-free assets versus just at-risk assets? So that concept's been going on here for years. And we have different versions of that. Some of our cash or money market or our indications triggered in actual models triggered in March, at the end of March. So we've been at this game of some things having cash, some other things not yet having cash. As that process goes through time. Keep in mind, in context, the average equity fund of any kind on our whole system scores at a certain score. Let's say it's 2.4, 2.39, somewhere in there. And that is actually the low score of the COVID low. So we've matched that, let's say, over the last day or two. So we're in that context where scores have really been hit to that degree. And then, we don't know what tomorrow brings, but we are oversold. But again, still the point is that equities had a severe test here, and in some of those tests, both in group scores, where cash is stronger than the average equity fund. It's also true in the equity U.S. equity part of Dolly that cash is now ranking stronger than that U.S. contingent. So so there's the kind of the similarity between the two systems. Showing you how great the stress is in the market. You don't really see, this kind of thing, every year. But there's a pattern of these things happening to some degree, every several years, and we're back at it again. So the real question is will the cash go to number 1, which I wouldn't like to presume that it would, but we have to monitor those things to see where it is that it moves up or moves back down.
Yeah,
I've seen cash indications, that say cash is stronger. They can peel back rather quickly under the right bullish circumstances in the equity market. So far, even though there have been some rallies along the way during this 2022 session, none of them have been able to stop this trend of lower readings.
And I think that's the other thing. I mean, it's a good point to touch on. It's like you talked about the global equity, that all equity funds group, right? I mean, the 2.4 score range, pretty low, but it's not like heavily oversold from a group overbought oversold standpoint. I mean, you see that kind of that stair stepping lower. You're down a lot, you're up a little bit, you're down a lot, you're up a little bit. I mean, that's going to kind of you're still in oversold territory in a lot of these broader indications, but it's not like anything like we saw in 2020 or even 2018. You saw like some pretty intensely oversold readings.
You have to interpret the thing you're seeing in context with that the time in question. For example, the 2018 sell-off was super rapid. And that doesn't allow trading bands a chance to catch up. So you get extreme readings when things move fast. The 2020 COVID sell-off was literally the full down move was only 21 days. So that expands the trading bands rapidly, and you get big numbers when things move fast. Which again, I would prefer to see those kinds of markets. It's the slow move down that keeps the trading bands from getting too big in the numbers. But you could still say that we're still 100% oversold in this paradigm. Whereas if it moved a lot faster, then that number would be much greater.
Right.
So in context, I think things are working at the speed that the market's going. The market's moving in a very methodical or orderly pace. You could say for 10 months on the non-US, following this, what we call this negative score path, or this descent in strength. And of course, the last big piece of equity to join that negative descent is really the core of the US itself. So that was you call the last man standing principle. That's where we find ourselves today. But I think it's important always to recognize whenever cash indicators are moving, as well as fixed income indicators moving, why are they moving? How many systems see this movement? What are the rankings? Because see, those rankings actually are going to end up causing you to change your asset allocation. If equity is number 1 or 2, then your equity allocation is always, right there, and you're doing very similar things that you may have done over years. But if rankings start changing, then that's the alarm that models are changing. You should weed out the laggards. You should be careful with those equity components that are let's say worse off than best of breed. But one way or the other, it's going to change the allocation.
Right.
And we've seen that in some of our models. Some of our models have gone to cash partially or completely. Some of our models have not gone to cash, but have raised certain low volatility assets within them. That's their way of being defensive. And again, we're still in a moving story. So although it is 6 months into this year, you'd say the chapter's not over yet. I've never seen a market kind of not do anything after hit the negative 100% oversold reading on a overbought oversold curve, meaning it's going to move. Is it up or down?
Right.
But we're going to see some activity. So the story's not over yet.
In that concept of volatility, I mean, we talked a lot on this podcast through the course of the past few weeks about really low levels for a lot of like the participation indicators, like your bullish percents, your positive trends. I mean, when we see stuff at low levels, I mean, you would think, I mean, just in looking at it's low, it's got to go up, right? Yeah. But when it's at these low levels, I think an important thing to keep in mind is it's not necessarily just because it got down there, it means it's all of a sudden going to turn around and reverse back up. I mean, you're going to see that volatility kind of bouncing back and forth.
Yeah. One of the ways we would tell ourselves, or we're certainly used to, is say that, we just don't know how long it will stay in that low field position.
And that's why we have them. So we wait to watch it.
Right. So you got to see the improvement. And sometimes indicators take 2 reversals up, up, down, up, back up, to get a solid a signal that ends up being very helpful. And that's it. When you get to low field position, you don't know the time increment. Things can stay low for many months. 2008 was an issue like that, where you first reach these massive south low field position levels in most indicators, and very high money market rankings and so forth. But they stayed that way for months. That wasn't over next week, let's say. So there are reasons to be cautious with low level. On the one hand, you're educating your client, hey, we're getting ready to make some proactive moves. Here's what we're looking for. Make sure, the client's ready to roll, because usually when indicators are in the lowest field position is when the public is frightened, scared to actually be proactive And that's why the advisor really is there to say, hey, no, this is actually what we're waiting for. And we're just playing this correctly by waiting for some positive indications to come out of low field position. I think that's a great game plan. But it's never going to feel great.
Right.
You know,
It's never easy.
all, you know, as some have said, this looks like a bear market, but all bear markets are messy. I mean, all of them were, they will be. So the idea of having a game plan is, well, you know, you've got the indicators. Okay, we're working with them. We have cash indicators. We've raised some cash. We're doing things. And then when we get into low field position on equity indications and we get a reversal up and possibly two, I mean, that really is going to produce an enormous opportunity. And generally when people are exhausted with or with fright.
Right.
So those things go hand in hand. But that's why we have a rules-based system where here's where we look at moving in, and that time could be right now. And we could see rallies begin within a couple of weeks.
Yeah, and I mean we've seen a little bit of a pickup. Like we kind of started off this, we've seen a little bit of movement up, but the thing we're not seeing the indicators improve yet. Right? I mean, with the we were up over 2% yesterday, up another 1% today in the Nasdaq. I mean, you're seeing that's improvement. I mean, when you're seeing green on the screen, it's a lot better sign than it is most days when it's just all red like it was maybe toward the end of last week. But we're just not seeing that kind of longer term improvement on some of these indicators like we're talking about. Even on these upswings, I mean, it's more like a rebound out of that kind of oversold condition on some of these than it is that kind of broader based technical improvement that you really want to be looking for.
Right. You just have to run the play that you can run.
Right.
And then string those together with future plays that will be run, that we will run. And that's just part of, the downside of not understanding the future ahead of time is that now we have to just run a game plan. And so that we, work the game plan here, and we just have to be patient. I can tell you that, rallies, there will be magnificent rallies, indications, could improve, might improve. But we're just in this period of time where you're really trying to hunt down one of the three pieces of the game plan, which is what to buy. Of the things that are available, and they could come from many different areas. The commodity energy area is probably most likely of holding up fine. Of the core assets, maybe the low vol's better than the high vol of the core assets. Of non-US, there are some better areas than others. And of course, I have to go back to this fixed income, which is fixed income does have areas that I see score at 3 or higher. Right. And you just cannot deny that.
You talk about beat up, washed out areas. Yeah. So they got hammered in the first several months of the year.
It's important for asset allocation to get back to this idea that we just don't write off asset classes and take them off the system.
Right.
We go back and say, no, we've had a negative view on much of fixed income for quite a while. But some of those groups are coming back into relative play. In fact, I could make a statement here, which is true, that the average fixed income fund of all fixed income put together in one big fishbowl has a higher score than if I did the same thing with all equity funds.
Wow.
So again, we want to go back to saying, well, but
and you, I mean, I want to classify that too, because I mean, it's not just it's all U.S. equity. I mean, if you're taking that all U.S. equity diversified, I mean, just looking at fixed incomes 2.74 and U.S. equities too. So it's not even, people have been, I guess, international equity's been out of favor for a while. So even if you're just looking at that U.S. versus fixed income, I mean, that score paradigm's changed.
That's a good point. And to go further is we don't know how that's going to unfold, but we do know that that's a challenge, meaning that has actually happened. And you don't know the psychology. Maybe we don't. Maybe no one knows for sure the psychology of the big money and how the smart money, wherever we tag this big block money in the market. We don't know that they haven't said to themselves, "Well, we're picking up more fixed income. It's been tortured enough," and that's how they're going to proceed. And it very well could be. So cash, fixed income, domestic equity. Then you got the non-US equity, and of course, the commodity piece. But commodities can only hold so much of your netta, meaning it's not a big enough space for you to put all your money in.
It'd be great if it was from a return standpoint.
Yeah. That'd be easy to say that that everyone
right.
is able to do that. So you really do need to know the status of U.S. equity, non-U.S. equity, fixed income, and money market, because that's where that asset allocation's got to be spread out. And take note that if this is an extended bear market, that we probably will have higher increased weightings in money markets and fixed income as we step along the way, heading for that better place when equity starts to, really bolster up. And we don't, quite frankly, that's why we have tools. We've got to know how the non-U.S. is coming along, and then the U.S. We can say historically and in observation right now that the non-U.S. went out of favor much earlier. It's been beat up and going through you would call a maturation process of being negative much longer than the U.S. And so it's possible, we've seen this in the past, that they come out of the hole first down the road here, and but you never know. So what we do is we take a look at the readings and go with the best fund selection. For the best portfolio is, well, what did you actually buy? If it's ETFs, well, what each ETF is doing relatively better than its competitor, right? And that's how we do this. But I think it is fascinating that we're in one of these markets where the cash has moved up to enough of a prominent level that it needs to be highly respected.
Yeah, certainly. And I mean, I think looking at some of these, we talked a lot about cash, talked a lot about fixed income. That doesn't mean there isn't anything else working, right? I mean, we're seeing, as Steve said, we're seeing commodities are still strong. You can't allocate but so much toward it. But we're still seeing some strength in some of the more commodity related areas within domestic equities. I mean, your energy, your basic materials kind of areas. A lot of that stuff's pulling back today, especially. We're seeing a pretty notable pullback over the past couple of days in crude oil. And that's going to lead to some normalization on a lot of the stuff that might have been a little bit overbought because it was the only place to be in with the domestic equities for a while. So another potential area that could kind of be looked toward there. But I think, Steve, you made, the great point that sticking with the game plan, having that objective approach that you're looking at, whether you're looking at Dolly, whether you're looking at group scores, they're saying a lot of the same kind of stuff right now.
Right. And there's a relative relationship, like, for example, energy has a relative relationship to the other asset classes. And just because it has a big price pullback doesn't mean the relative strength had a big pullback. This is very important. Take note, I say this often, energy and commodity related assets have at least twice the relative variance as the base core market. You could say they'll move twice as much in either direction and still be normal to their own behavior as the equity market. So you get massive volatility in energy and commodities does not mean it's abnormal. What we're really keen on is, are they holding that relative leadership? And there's no question that they are. Some precedents for this are different pockets in time, but in the 70s, commodities and energy related assets, if you added up all 10 years of the 70s, they dominated at least 80% of that chronological time, and then had some sharp pullbacks, in the middle of those times, and then jump right back up into leadership. So I do understand the high volatility of that asset class makes it a little bit unnerving to handle, but that doesn't mean it's not operating normally. Yeah. And I think I think we can confidently say we're still at number one. We're still at high dominance in that high volatile area, right up until something else shows that it's more dominant. Because there is one fact that we often see, and I think it makes sense, is that leadership is usually caused by high demand, and that's where the investors want to be. That's where the smart money wants to be. When we see that shift to become a laggard or go out, that's not how it happens. What happens is smart money, big money, and investors move to new areas that they like better, and those areas come up and take the new leadership, and they build that base, and they get to that leadership, and then the old leadership falls off. So keep in mind that no one's going anywhere until they find something that they want to buy, and what they want to own is this area. Also keep in mind that commodities, energy, and spent years building a higher base of relative strength along the way. They didn't just come out of nowhere.
Might feel like it, but
yeah, it feels like, when you have 50% returns in a year, it feels like it came out of nowhere, but this has been building and building and building. And so, our tool set allows you to take a look at some history of things, and you can track in time, meaning now, what asset classes are starting to improve, who's going to start building a base northward on a relative strength basis. And quite frankly, we're still in a position where the equities are still in that down move of relative strength, but we'll be able to, we'll see upticks. I think that the latest asset class and tranches inside itself that have showed improvement from where they were is fixed income.
Right.
So, that's the one that has caught our attention. Let's say it's caught my attention. And and there's another story, stepping its way through time. And then again, we keep looking to see positive signs from various equity groups, and we'll just have to be patient to do so.
Yeah, being patient and kind of continue to follow that game plan and follow these indicator changes.
Right.
And I mean, as we continue to do, whether it's through the daily report or whether it's through the media content or this podcast, I mean, we'll continue to try to keep you all, the listeners, kind of up to date with any changes that we're seeing on a daily basis through the report, on a weekly basis through this podcast. Because there's certainly a lot moving on underneath the hood, not just in equities. I mean, like you said, in fixed income too, and as well certainly in that commodity space. So a lot of stuff moving on. We'll continue to try to keep everybody up to date. But in the meantime, Steve, I think that wraps up most of what we were looking to cover here. So thank you for joining us here this week. And to everyone listening in, thank you for joining us this week as well. And we'll be back to talk with you next week.